I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer. And I have a very special guest on Coffee with Lynette today, Jason Hartman, who is the founder and CEO of Platinum Properties Investor Network, Inc. That helps people purchase income property in prudent markets nationwide. And we're certainly going to talk about that today. With podcasts and events, well, he is certainly an educator in real estate investment. And I wanted to have him on because certainly real estate can be an income producing asset and is a very important part of the ITM strategy, though we're looking at it more through the lens of a reset. So the question on everybody's mind is real estate in a bubble? And I know that's something, we've got the Case-Shiller index at, way past 2006 levels at the previous peak. And we have interest rates that globally are nearing zero. And real estate is certainly such a huge part, 30% of the global economy. So what do you think?
Yeah, well, that is the $64,000, really $64 trillion question, maybe. But there are many metrics, Lynette, that we'd have to look at to decide and really answer that question of, are we in a bubble when it comes to real estate? Because, of course, all real estate is local. Just in the U.S. alone, there are 390 something metropolitan statistical areas, or MSAs. There are over 3,100 counties in the country, and there are numerous cities. I don't even know how many they are. This is a very large country. And then, of course, you look around the world, it's a big world, right?
Right.
So you'd have to ask, first of all, where? Second, what product type? Would it be high-rise condos or single-family homes or multifamily housing? And then what would it be? Luxury? Would it be entry-level workforce housing or anywhere in between? It's complicated, which is like my favorite Facebook relationship status. It's complicated. I love that one. It's so funny. It's always complicated. Married, single, doesn't matter. It's always complicated. But anyway, it's like an onion, and you have to peel back many layers to get to it. And even after answering or discussing all of those issues that I just raised, we would then have to think about, what factors influence whether we're in a bubble or not. Is it just prices, like you talked about Case-Shiller, the most widely cited index? Or would it be about the payment on the property? Would it be about affordability and unemployment? Would it be about other factors in the credit markets or the financial markets in general? There are a lot of things that go into answering that question.
Right.
And I'm going to tackle a couple of them today. And I've got some good data, some good charts and slides to share with your audience. But this is not intended to be a complete answer to that question. And I know you've been talking about this idea of a reset.
Correct.
And I've had guests on my show over the years talking about this idea of a debt jubilee. That's certainly an interesting concept. And, I just watched a Glenn Beck show where he talked about how the reset is being set up all over the place. And, some of it's a little conspiratorial, but maybe not. It's pretty interesting.
No, actually, Jason, the World Economic Forum, their whole title is Reset, the reset, both socially, economically, and financially.
Right.
And in reality, Christine Lagarde, when she was head of the IMF, talked about the reset regularly, really since 2008, which is when I've been talking about it. So it's not conspiracy. They're talking about it now. And we just recently had the Federal Reserve change how they were going to look at inflation and no longer target it at 2%, but allow it to run hotter. So,
right.
I think it's right out in the open, and we certainly have some historical data on how real estate performs during them. But I want to see what you brought.
I think that's a very good point. And, I'm definitely going to be talking about our rich Uncle Jerome Powell. So
Yeah, he's rich because he can push a button, right?
he can push a button and change the world with that button. That's for sure. But let's dive into the bubble question because that's the one people really want to know. So if you look at housing prices, just like you said in the intro, Lynette, it's commonly cited. People are talking about this a lot and they say, wow, you look at housing prices, they have skyrocketed. In fact, housing is more expensive now than it was before the last bubble pop, before the Great Recession or the GFC, whatever you want to call it. The prices are higher now than they were then. And that's true. Now, of course, it depends what market you're talking about. And when we look at real estate around the world and around the country, we divide it into three types of markets: linear markets, cyclical markets, and hybrid markets. So most people talk about cyclical markets. These are the trophy markets. They're the markets that get all the attention. All the news media pays attention to them. So they're places like where I grew up in Los Angeles, California, San Diego, San Francisco, Seattle, New York City, Boston, Miami, Washington, D.C., and around the world, they're trophy cities like Paris, London, Dubai, Hong Kong, etc. So these are the markets that get all the attention. But when you look at the whole world or the whole country, they're really a relatively small number of markets overall. Okay. These are the markets that if you're looking at a graph, they look like a roller coaster. They have glorious highs and really ugly lows. They go up, they go down. They're cyclical, as the name would imply. Linear markets, on the other hand, are most of the world and most of the country. They're markets that sort of just chug along. They're boring. They don't get much attention. They appreciate slowly, and they have small ups and downs, small peaks and valleys, but they're not very significant. Okay. So that's how we divide them up. But
okay,
here's the housing prices. What do you think? Bubble?
Well, yeah.
Most people do. And again, there's a lot that goes into that, right? There are many factors that influence whether it's a bubble or not. But let's just look at prices compared to inflation, first of all. Let's first of all adjust for inflation. And I know you talk about this a lot.
Right.
So, of course, the flawed but most widely cited measure of inflation is, of course, the consumer price index. It is flawed. We both know that very well. But just comparing the Case-Shiller index to consumer price index, we see that they are out of sync again. Okay.
Oh, yeah.
But if we do compare to inflation, it gives us a little bit of adjustment because they're not quite as high as the prior chart that doesn't account for inflation. When we adjust for inflation, it's not quite as extreme, but it is still out of whack. I'll be the first to agree with that. So let's look at this. Oh, this, by the way, is Case-Shiller versus the S&P. You could argue that the S&P is another good
bubble
measuring stick, or another bubble. Yes.
Hey, yeah. I mean, print that money, pour it into all these markets that are targeted for reflation. So, yeah.
Absolutely.
Although the biggest bubble is the debt bubble, but
yeah. No question about it. So here is the person of the day, our rich Uncle Jerome Powell, right? And they are printing money like it is going out of style. It is
correct.
Unbelievable.
Unlimited.
We all thought it was crazy during the Great Recession, right? And the amount of money creation back then. But you look at it now, and I mean, it's just unbelievable, right? Unbelievable.
Well, when you know you're going bankrupt, why not go for broke?
And you know what? As long as the U.S. can maintain the reserve currency status, it can get away with a lot. It really can.
Yes, it can. As long as as long as they can maintain the confidence of the world and the confidence particularly of the public. And that's really what's what is deteriorating.
Yeah, and it is definitely deteriorating. People do not believe the news media anymore. We all know what's going on out there, right? But let's just talk about inflation for a moment, if I may. And
Absolutely. One of my favorite topics.
it is mine too, because inflation works against most people, but it really works in favor of some people.
Yes,
And so
it does.
to understand it, of course, we need to distinguish the difference between real and nominal, or between price and value. Nominal, of course, means in name only. So,
Right.
A $20 bill is still called a $20 bill, even though it was called the same thing 50 years ago, but the value of it is much lower today
Right.
because
Purchasing
it keeps being
power.
debased by all this fake money creation.
Mhm.
So inflation is this insidious hidden tax that destroys our purchasing power. It destroys the value of savings, stocks, bonds, equity, and real estate, actually, and the value of debt. Okay. It destroys the value of debt. That's the good part. So we can use this to our advantage potentially, right?
Right.
Inflation is the most powerful way to redistribute wealth. It's not taxation, it's inflation, because it's subtle and people don't pay attention to it. They don't understand it. Taxes, hey, the government's taking too much of my paycheck, so I'm going to riot in the streets, right?
Right.
That's what happens with taxes. With inflation, much more subtle,
Said they
but
knew
much
that.
more deadly.
That's why they set the system up like this.
Absolutely. And isn't it interesting? I'm sure you've talked about this before, that the Federal Reserve comes along just over 100 years ago, and right after that, the IRS comes along.
Isn't that interesting? You think that was a coincidence?
Just a big, huge coincidence. Yeah. Yeah, absolutely. But inflation does distribute wealth from lenders to borrowers, because the borrowers have the benefit of paying back their loans in ever cheaper, debased dollars.
Right.
And that can be a beautiful thing, a really
It can
beautiful
be.
thing.
Absolutely.
Yeah. It also transfers wealth from old to young. And the reason it does that is because mostly older people have assets and savings, and younger people have debts. And so that's just a generational wealth transfer without even having an inheritance. It happens right there. So let's look at this. Back in 1976, my mom bought her first house. It was our bicentennial year. The country was 200 years old. And so I thought it was kind of interesting to look at this as a year. The median home price back then was $44,000. I'll just round off in the interest of time. So only $44,000 would buy you the median home in 1976. The interest rate in 1976 was 9%. So the payment on that mortgage was $354. But if you adjust that for inflation, oh wait, we're not going to do the inflation adjustment yet because we've got to go through some time first.
Okay.
So now just remember that $354.
I remember I bought my first house in 77 and my payment was $459 and I was paying actually 12%.
Yeah, amazing.
And I think I paid $52,000 for the house.
Yeah. Yep. My mom, her house was $62,000 and her payment was $416 a month a year earlier. So there you go. So 1984 comes along and we are living in Orwellian times, aren't we?
Yeah, we are.
Yeah, scary,
Today. Yep.
scary stuff. And COVID 1984 has given every government in the world a real excuse to surveil us more than ever. But in 1984, the median house was $81,000. So it had gone up quite a bit, almost double. Okay. And the interest rate was almost 15%, 14.68. Okay. So now that payment on the median price house is $1,003 per month. I'll just kind of round off here in the interest of time, $1,003. And if you calculate for inflation, okay, from 1976 to 1984, okay, with the inflation calculation and the interest rate calculation, you're actually saving $356 per month. Isn't that amazing, right? And people wonder why real estate just never seems to stop. It just keeps going like this, the little engine that could. It just won't stop going crazy. And, everybody keeps saying, oh God, there's got to be a bubble. I mean, I remember people telling, we had clients in 2013 and 14. Okay. This is, 6-7 years ago, saying it's a bubble. The market's gone up too much. It's a bubble. It's going to crash.
Well,
and
truthfully, it is being targeted for reflation because of all of the products that they've created from, mortgages and everything else. So, it never really allowed itself to express when the bubble first burst in 2008. But
that's a very good point. It's always manipulated because interest rates manipulate the market very significantly.
Oh, yes, they do.
I don't agree with it. I think the low interest rates we have now are totally fake. They're fake news. But, and I don't like the powers that be, and I don't like what they do. In fact, I speak out vociferously against them. But there's a difference between philosophy and investment practice and what we want to do in our personal lives, right? We want to align our interests with these powerful forces, governments and central banks, even if we disagree with them, because we should disagree with them. There's a lot to disagree with.
Indeed, there is. But I'll let you continue because this is very interesting.
Okay, so now let's move up to 2006. That was the last big peak, right? Before the housing crash, before the economic crash, before the global financial crisis. By 2006, the median price was $235,600. So houses got a lot more expensive, or so we're told. But then look at the interest rate. The interest rate was 6.78% at that same time. So the payment is now $1,532.80 per month. But when you adjust for inflation and the lower interest rates and the new higher price, you're actually saving money. The house got $414 cheaper from its 1984 price. So 22 years go by and houses actually got cheaper. Now, the reason I say all this is the house did not get cheaper, really. Okay. If you're paying cash, the house got way more expensive. It got, interest rate and inflation. Hardly anybody buys a house based on the price. Almost everybody buys it based on the payment. Okay. And it's a credit-based asset, just like automobiles are, just like, sadly, rip off student loans and college tuition, right? But the facts are the facts. It's the way it is, right? So on a payment basis, on a principal and interest payment basis, the house got cheaper. And it keeps getting cheaper. You're going to be amazed. Let's keep going. Let's go one more segment. Let's look at today. So today, the median house price is way up to $313,000, like you said, higher than it was in 2006, okay? Higher than it was back then. But the interest rate is absurdly low.
Correct.
And it's even lower than this, okay? Yeah. It's on the Fred chart from the St. Louis Federal Reserve, just a few weeks ago, a couple months ago, it was 2.99%. Okay.
Yeah, I think it's now 2.59 or something like that.
Isn't that frankly ridiculous, but glorious at the same time, right? Let's take advantage of it. So now the median house will cost you $1,318 a month, $1,318 per month. And when you adjust for price, interest rate, and inflation, all three factors, from 2006, the house actually got $657 cheaper in 2006. So in 14 years, because of the artificially low interest rates, thanks to our rich uncle Jerome Powell, our Federal Reserve chair, housing is cheaper than it was in 2006. And guess what? This is really going to amaze you. Let's go back to 1976, where we started this journey, okay? And let's look at all those three factors considered, and the house today is actually $299 a month cheaper than it was in 1976. Isn't that incredible?
But, just kind of staying along there and everything else we've been talking about, I am really curious if you think we are going to see negative mortgage rates in this country like they've done in Denmark.
Well, that's a very interesting question, Lynette. And I would first argue before answering that we already have negative interest rates, because after real inflation or even targeted inflation of 2%, which now has gone out the window because Jerome Powell does not care about inflation. He's publicly stated he's not the least bit worried about that. But the Fed's target has always been this 2% inflation rate.
Right.
And if you buy a property and you don't rent it out, which would be crazy, I'd recommend everybody rent their properties, of course. But if you buy a property for investment and you just let it sit vacant, you're literally getting paid to borrow that money today. Because if you believe, and you look at shadow stats, I've had John Williams on my show. I'm sure you're probably a follower of his work too.
Brilliant man.
The inflation rate is massively understated, and the three major ways they understate inflation is through weighting, substitution, and hedonic indexing. Okay, and I'd be happy to go into that, but just know that there are three ways. So look, it's understated. So if you believe the inflation rate is just a modest 2% now, not looking at the cost of healthcare and the fact, what else the index doesn't look at, Lynette? I've always thought this was interesting. It doesn't look at the fact that nowadays we're doing everything ourselves. We live in a DIY world. We live in a world where, maybe the cost of the airline ticket hasn't inflated that much, or the cost of gasoline hasn't inflated that much as we think, but we're pumping the gas ourselves. We're getting our airline ticket ourselves. Everything is do it yourself now. And we all have all of these little frustrations in life. We go to a restaurant. I used to live in Scottsdale where you are, and they have great restaurants in Scottsdale, and you go to all these cool restaurants, and guess what you do? You go to the counter and place your order, and you stand in line waiting, you place an order, and then maybe they give you a number and they bring it to you, but they certainly don't wait on you. You don't get real waiter service, right? Yet you're still expected to tip the same. And so the prices are higher. So you get less, but you're still paying more. So don't forget about this self-service society we live in. A lot of this stuff, we used to have people waiting on us, travel agents, gasoline people would pump your gas and wash your windows and check your oil and check your tire pressure and, change the water fluid in your thing. Now, if you want to put air in your tires, you got to go pay $1.50 to run the pump. And you do it yourself. So inflation is real, folks. Okay. It's all over the place.
It is.
If inflation is 2% and the mortgage is tax deductible, and your combined federal and state tax rate, if you live in a place like the Socialist Republic of California, where I'm from, or the Socialist Republic of New York, you're paying over 50% to the feds and the state, probably, or close to it. So let's just call it 50 for round numbers sake. So if you get a 3% mortgage and you've got a 1.5% of that is deductible, now you're down to 1.5. If the inflation rate is 2%, you're getting paid 0.5 to borrow the money if you never rent the house out. I mean, it's unbelievable. It's not only free money, it's you're getting paid to borrow money today. And that is so it is so dysfunctional. It just isn't a normal thing.
This has just been such a great conversation on property taxes. Have you done much, I'm sure you have, in the growth of property taxes?
Well, property taxes are under attack where they are low, like the Socialist Republic of California. They're trying to repeal Howard Jarvis's Prop 13 from 1978, and they'll probably be successful. California, and I pick on and mention California, not only because that's where I'm from, and it's a great place to be from. If you live there, you should try to leave, because that's the thing to do. I left 9 years ago. Best decision of my life, by the way. Prop 13 is under attack. California has all sorts of just nutty proposals in their legislature. It is absolutely crazy. One of them that you kind of alluded to a moment ago, Lynette, is that they are trying to make it impossible for professional investors or corporate investors to buy foreclosure properties, because I think they sense that a foreclosure crisis is coming, and they don't want the business people to buy the foreclosures. They want them to go to all the like first time buyers. So that's going to totally distort the market. And that'll be a disaster. I mean, it seems like a good idea, to help with the housing crisis. But if you want to help with the housing crisis, just let people build some houses. It's called capitalism. It works great.